On today's Hot Sheet, I'm discussing home price changes, FOMC minutes from December's meeting, and 3 labor reports. Today is Thursday, January 4th, 2024. I'm Byron Lazine, and the Hot Sheet starts now. Welcome to this edition of the Hot Sheet. If you're here in the live stream, let me know in the live chat which market you are tuning in from today as I sit here in my Connecticut studio with all of you. To get the most out of our content at BAM, join BAMX. Use code 2024 today to get 25% off of your BAMX annual subscription. This is where we release all of our show notes from this show, all of the slides, all our courses, live streams, and of course, the community. Use code 2024 to jump into BAMX today. And now let's jump into the show. Yesterday, if you missed yesterday's Hot Sheet, I was talking about the gifts that were given to the industry. Well, Jerome Powell might have taken those gifts away. We're going to get to that here in topic number 2. But first, let's jump into the Freddie Mac House Price Reading Index. This is a report that says U.S. home prices fell 0.2% during the seasonally soft window of October 2023 and November 2023. Lance Lambert from Resi Club, who will be on Knowledge Brokers podcast on Friday, put together a searchable table that is just absolutely outstanding to take a look at not only that these month-over-month numbers from the Freddie Mac house price index, but also what the 384 metro areas that Freddie Mac tracks have done since the 2022 peak and what they've also done since March of 2020. Let's take a look at the table here. Now, you can see all the way to the right since March 2020, most locations have just skyrocketed up in that 40+% range. This is in alphabetical order. Again, 384 metro areas that Freddie Mac tracks. If we scroll down, we know Austin is one of those metro areas that has been in the news a lot for having dropping home prices. And you see the negative 13.9% from the peak, which is also the 2022 peak was Austin's peak. And so both of those numbers are the same. Their peak was in 22. So you see the 13.9% reflective in both of those categories. But if you look all the way to the right, it tells a different story in Austin. Since March 2020, Austin went up 40.4%, still even with those 13.9% drops. So essentially, a place like Austin just went up too much. But if you were a buyer in 2020 and you've held on to that property through today, you're up over 40%. And this is where a lot of the gurus, YouTube talking heads that said, don't buy a house, real estate's going to crash in late 2020 and 2021, got it dead wrong. They cost a lot of people a lot of equity or a lot of money. If we go down here, they've got the month-over-month numbers. That'd be between October 23 and November 23 per the Freddie Mac index. Year over year, that's between November and November, down from peak, which would be that market's respective peak. And then since the 2022 peak, and then, of course, since March 2020 as described. So if you'd like to, there's 384. This is one of the best ones I've ever seen. This will obviously, for BAMX members, you can find this searchable chart right in BAMX. That's where we share all of our research, all of our show notes. This will be linked up for you in BAMX. But if you want to grab a couple locations right now, throw them into the live chat. This is the best one I've seen because it's so robust. It's 384, markets. So like today, I just put in Connecticut. I'm like, what do they have? Connecticut. What Connecticut markets do they have? And boom, I put in CT, and here they are. I've got the Bridgeport, Stamford, Norwalk area up 50% since March 2020. Connecticut's interesting here because most Connecticut locations, look at the Norwich, New London area, are up since their 2022 peak. Norwich and London has, since the 2022 peak, has gone up another 11.6%. We talk about the Northeast a lot having this lack of inventory. which has accelerated the prices in places like the Northeast since the 2022 peak, now showing some downside from recent peak just a couple of months ago. I think we saw Tampa. Let's check out Tampa Bay. Tampa, St. Petersburg, Clearwater, Florida metro. It's since March 2020. Look at Tampa, up 71.5% since the 2022 peak, up another 4.2% year over year, up 6.9%. Tampa Bay is just an absolute screaming market. Like, when will Tampa slow down? Maybe it'll be here in the beginning of the year with all of the rental inventory that's coming onto the market. It looks like we've got Denver in the chat here. Let's take a look at how Denver's looking. Denver's up 32% since March 2020 peak. Now, remember, like, take into consideration the amount of people over the last decade, really since 2011, who have migrated to Colorado and specifically Denver. So Denver, not surprisingly, is showing a more modest gain since March 2020 because they had significant gains in 17, 18, and 19. Certainly, I think Gabe would be able to tell me better because Gabe sounds like he's from Denver. But Denver had huge growth leading into 2020. And so maybe the growth hasn't been as strong since, of course. But 32% still a whopping number, down 6.4% from the peak there. What else do we have? Just New Jersey. Which metro in Jersey? If we just take New Jersey, here's New York, Jersey City. This is more like, lower Manhattan and Hoboken, I'd say, for this metro. 40.2%. This might include all of Manhattan. 40.2% since March 2020. 6.1% from the peak. If I just go NJ, let's see if we get here's some other Jersey areas. Atlantic City's up 75.7% since March 2020. Wow. Up 12% from the 22 peak. Trenton, Princeton area up 58.1% since March 2020 and 14% since the 22 peak. You don't see really any out of the 384 that are down since March 2020, do we? Ocean City up 68% from the peak. Rochester, let's take a look here. And there's Rochester, New York, 52.6% since the March 22 peak, another 10.5% from the 22 peak. Look, all of the, specifically Northeast, you see these wild, jumps from just 22 to 23, double-digit increases in a lot of these metros. And unfortunately for a lot of buyers in 22, they were counting on the market to come down as interest rates went up, and that just did not happen for them. Those prices obviously continued to increase, and these numbers are validating that. Charlotte, let's take a look at Charlotte. Charlotte, if I could spell it. Nope. Look at this. Look at this. Where is it? There it is. Charlotte. Okay, Charlotte, North Carolina metro, which includes Concord, up 60.4% since March 2020, 4.2% since the 2022 peak. A lot of iBuyers in Charlotte, a lot of institutional buyers, yes, for sure, in the Charlotte area. We discussed that, I think, in December. OKC for Jody. Let's take a look. OKC. Oklahoma City is 41.8%, up 5.4% since the 2022 peak. So 384 metros here. We'll do one more, Columbus, and then we'll get into the Jerome Powell taketh as he gives it. Columbus, I got to spell it right. Columbus, Ohio. Bunch of Columbuses out there, but Columbus, Ohio specifically, 45.7% since March 2020 and up 5.3% since the peak. Okay, that'll be available. If you want to play around with that, check out your market metro. I mean, I would definitely use these three categories per the Freddie Mac data, month over month, year over year, down from peak, since 22 peak, since March 2020 peak, in an email blast, in some piece of content for your market. BAMX members, you can just grab this link inside of BAMX, and as well as all of our other downloads from this show and every show here on the Hot Sheet. Anything else that jumped out? There was 18 markets with a year-over-year decrease. We already talked about Austin, Lake Charles, Louisiana, Pine Bluff, Arkansas, Cheyenne, Wyoming, Cheyenne. There we go. I gotta have Bobby here. I've never heard of Cheyenne, but I'm sure it's a beautiful place. Sorry, Cheyenne. Hammond, Louisiana, Jonesboro, New Orleans, Louisiana, Lafayette, Louisiana, Baton Rouge, Louisiana. Louisiana got beat up this year. Odessa, Texas, the Villages in Florida on there. Idaho Falls, Pueblo, Colorado, Boise City, and what else we got? Cape Coral's in there, Fort Myers. So those are the decreases year over year. Full list, obviously, in the show notes for BAMX members. Okay, moving on to Jerome Powell. Jerome gave us a big gift at the end of December, seemed like, but now I'm starting to think he played us. When we had the December press conference from Jerome Powell, he said, we're going to cut the federal interest rate 3 times in 2024 was the first time he said that. The markets took off. You saw what the stocks did to close out the year in 2023. They went on a run, even leading up to that, with expectations that Jerome might say something like that. And what you saw the 10-year go from up over 5 and drop down into, at one point, the mid 3s. We've seen it here to start the year creep back up. And maybe it's been creeping just as it is today because of what was in the minutes. See, Jerome Powell might have said, you know what? I'll make everybody feel good going into the end of the year. I'll give everybody this early Christmas present and tell them I'm going to cut rates. But then I'll leave in the notes, right, the meeting minutes, maybe the underlying truth to what those interest rate cuts might look like. See, Jerome Powell and the FOMC committee say that they want to cut the rates, but they see a really hard path to getting there. They don't really know when they're going to be able to do it, and they don't really know how they're going to be able to do it without a much better inflation situation. So are we going to get there or are we not? Leaving some confusion here in the minute notes. And I think the market's going to have reactions to that. This is why in my end of the year projections, I just said it, while everybody's like, man, the rate's going to be down to 5%, the 30-year fixed, 10 years going to keep dropping. I said, not so fast. I just think there's going to be some more bumps in the road. This is certainly one of those bumps from Jerome Powell and from the FOMC. And I'm hopeful that we'll get enough good data. We're going to go into jobs here in a second and look at that data. I hope that we get enough data to combat this, but this is where we are at right now. Overall, members do indicate that they expect the 0.75 percentage point cuts by the end of 24, but there is a high level of uncertainty how and when the interest rate cuts will occur. Participants see the policy rate as likely at or near its peak for this tightening cycle, but the actual path depends on how the economy evolves. Okay, so today's labor reports, part of that. Future inflation reports are going to be part of that. Officials noted progress in bringing down inflation, citing eased supply chain factors and improvements in balancing the labor market. But there is a cautious approach given the uncertainty about inflation cooperation. Okay, so this is throwing a wrench in the mid-December momentum and euphoria that we had as it related to the interest rates. But what does this all mean for housing? The FOMC minutes are a 10-page document. We at BAM sifted through the entire thing and found the 3 moments that the FOMC mentioned housing in their minutes. So on page 4, residential housing starts moved mostly sideways and home sales continued to fall. Okay, so that is a way the FOMC is saying, hey, we're doing our job. That's a feather in the cap for the FOMC. They don't want to see an increase in sales because they believe an increase in sales could push prices up. But what they've done, which is restrict transactions, has actually pushed sales up. I believe prices up more than pushing sales down. I think they've actually had the opposite effect to some degree. I'm moving into page 5. In domestic credit markets, borrowing costs for most businesses, households, and municipalities declined over the intermeeting period, reflecting both lower, longer maturity treasury yields and narrower credit spreads, although borrowing costs remain significantly elevated. Rates on loans to households, including those for 30-year conforming residential mortgages and new auto loans, declined over the intermeeting period, while interest rates on commercial and industrial loans and small business loans were little changed. Going to page 6, several participants assessed that housing services inflation would fall further over time as the earlier deceleration in rents on new leases continued to pass through the broader rent measures. I agree. Housing service inflation will fall further. We've been saying this in the hot sheet for quite some time. Participants also discussed the role played by various supply and demand factors in the progress on reducing inflation thus far. They assessed that the contribution of improved supply has come from supply chain normalization, boost to labor supply due to a higher labor force participation rate in immigration, better productivity growth, or increased domestic oil production. They also noted that restrictive monetary policy had helped restrain growth of demand, particularly in interest-sensitive sectors such as business fixed investment, housing, and autos and other durable goods. Okay, so that is all for housing in the minutes. There wasn't much when we took away from the conference in December on housing either. So in line with the conference there. But what's not in line with the conference is you just don't get, when you read these minutes, you don't get the same feeling that the market got when Jerome Powell got up there and explicitly said, we're going to be cutting rates. This is the plan now. There's more uncertainty in these documents about actually when, how, where these rates will get cut. They will continue to monitor all the data that surrounds the economy, like today's 3 labor reports. First report up on the docket is the job openings report. This is directly from our show notes, which all of our BAMX members get. The number of job openings remain relatively stable at 8.8 million on the last business day of November, down slightly to its lowest level in more than 2 years. This figure is down from a series high of 12 million job openings in March 2022. So we've cut down over 3 million job openings since March of 22. If you remember there, it was like, I can make all these demands. That market is starting to shift here for people looking for a job. The job openings rate was unchanged at 5.3%. The openings decreased in transportation, warehouse, and utilities, and federal government, increasing in wholesale trade. Number of hires decreased to 5.5 million for November, which is down 336,000. The hires rate was little changed at 3.5%. Hires decreased in professional and business services. Okay, so this report here, this first report, is from the U.S. Department of Labor. It was released yesterday morning. This one here was released yesterday morning at 10 a.m. The other two were released this morning. The other two, including the ADP private payroll. Private payrolls increased by 164,000 in December, surpassing both the 101 figure in November and the estimated 130,000 figure. So this one here would be a black check against the fight against inflation, the way that the Fed looks at it. They don't want to see high jumps over expectations in new payrolls being added. You would think you want that because it makes a strong economy. People have jobs, but they don't want jobs to run away. That's why they like the fact that the first report openings are coming down. Still, 8.8 million openings is quite significant. We certainly don't have the labor force, obviously, to support that, or those jobs would be full. But the way the Fed sees it is, okay, if we get a lot more jobs over expectations being filled, this ADP private payroll report, which we did beat expectations, that can create a hotter economy that can kind of combat the fight against inflation. So the market is looking at this jobs report, and that's why you're seeing, we're going to get into the 10-year in just a second, you're seeing a little pop in the 10-year today because this is concerning for a little, very small little piece of data, but a concerning piece of data on how the Fed is going to react to it. Rebound in leisure and hospitality was a significant contributor, adding 59,000 jobs. Construction added 24,000. Support businesses added 22,000. Financial activity saw an increase of 18,000. Manufacturing declined at 13,000. The pace of earnings growth decelerated. Annual pay increases of 5.4%, those staying in the job, compared to 5.6% the previous month. So that would be the positive in this report. Market perspective from ADP chief economist: we're returning to a labor market that's very much aligned with pre-pandemic hiring. While wages don't drive the recent bout of inflation, didn't drive the recent bout of inflation. Now that the wage growth has retreated, any risk of wage price spiral has all but disappeared. So that's the good news. The wage growth is going down, meaning people's raises, but the amount of jobs going out did go up and beat expectations. Companies with fewer than 50 employees were the ones that added 74,000 new jobs. So seeing companies with 50 fewer employees continuing to add. Now, how about unemployment? This one was released this morning as well from the U.S. Department of Labor for the week ending December 30th. Seasonally adjusted initial claims were 202,000, reflecting a decrease of 18,000 from the previous week. The 4-week moving average was 207,750. And the seasonally adjusted insured unemployment rate was 1.2% for the week ending December 23, a decrease of 0.1%. So unemployment still very strong, still very low. Another sign that we have a very robust jobs market, very strong jobs market right now. The highest uninsured unemployment rates in the week ending December 16th were Jersey, Alaska, Montana, California. The largest increase in initial claims for the week ending in December 23 were California, Jersey, Missouri, Ohio, Pennsylvania, while the largest decreases were Texas, Oklahoma, West Virginia, Colorado, and Utah. All right. Let's take a look at what the market has reacted now off of these 3 jobs reports. I believe there's one more coming tomorrow. And let's just take a look here at the up to the minute as we sit here at 9:52 a.m. up to the minute 10-year look at 3.988. So inching up to potentially crossing 4%. We did cross 4% for a moment yesterday. Today, in the last 24 here, we've gotten as high as 3.999. So right at the 4% on the 10-year. This little pop up is a reaction, obviously, from the market on these job markets. And here's a forecaster to just put a little bit more cold water on the heat that we had at the end of the year when we were all buzzing about, where the rates were going. Here's a market forecaster, Jim Bianco, who I hope we're calling him Jim Rongo at some point later this year. Jim sees the 10-year Treasury yield surging to 5.5%, a multi-decade high. He's a Wall Street forecaster. It's a level that we haven't seen since G.W. Bush was president. Wall Street forecaster predicting benchmark Treasury yield hit 5.5%, highest level since May 21. A major part of the thesis built on the economy's strength and resiliency. I don't think the economy is hurt by 5% interest rates. I don't think the economy is really hurt by 7, maybe high 7% mortgages. I'll tell that to some buyers, Jimmy. I don't think something is broken because of these rates. Bianco sees inflation bottoming around 3%, but demand holding stable as catalyst. So, not everybody believes the 10-year is going to keep going down. Not everybody believes that the 30-year is going to, get down under 6% this year. In fact, I'm one of those that believes, I took the over on 6.375 as we do an average for the year. I hope there's long periods of time when we have a 5 handle. I'm certainly rooting for that, but it's moments and data like we have today that give me a more cautious approach to the year as it relates to those rates. Okay, it was kind of surprising that Jerome Powell did that in December. After you read those minutes that we went through here today, yesterday's 30-year fixed ended the day at 6.7, down slightly from 6.72 the day prior, and we'll see where it ends up today here off of this market news. You do have a stock market right now today that, let's see what it's doing. It is up. So Dow's up, S&P's up, NASDAQ down. Might be overheating there on the tech stocks is kind of the consensus going around Wall Street. That is your hot sheet. Use code 2024 to get into BAMX. Get the most content of our out of BAM by doing just that. That code will go away here by the end of the week. Hope everybody is super well today, and I will see you tomorrow. Until then, toodaloo.